I'm Sean Power, Financial Market Analyst at Capital Markets Elite Group, and in this video we'll give you an introduction to multiple reversal patterns using candlestick charts. So let's look at multiple reversal patterns using candlestick charts. In this video we're going to look at bullish and bearish engulfing patterns. They are a two candlestick formation that indicate or should put us on alert that there may be a change in sentiment or a change in trend. So let's look at, firstly we're going to look at bullish engulfing. So we're looking for a downtrending market with a negative session followed by a bullish session that completely engulfs the previous session's body. That may sound a little confusing, but let me just highlight here. So we've got this downtrending market, that's just a crude trend line. If I zoom in, we are looking for a two candlestick formation. And we have it here. I'll just highlight. So we have these two here. So what we have, if I can zoom in a little closer again, we have a negative session. This chart is on an hourly chart, so it's a 1 hour per candlestick. So we had a negative hour here, so we had an open there, close there, a red body denoting the negative period. We have a positive period. But there are key characteristics to look for. As the name suggests, we need the bullish candlestick to engulf the bearish one. So this is the bearish open level and this is the close. We need the open of the next session, which is just here, to be lower than the close. So it sort of covers that lower end of the initial body. We need the close to be above the opening level of this body. In this example, it completely takes out the high of the previous session. So this bullish candlestick has completely engulfed the previous range. We really, for this technical pattern, don't need it to engulf the body. So if the close was, for example, here, it would still engulf this body, but we have it here. So the logic is here that the trend has continued. We have sellers winning these sessions here. So we've got four previous sessions here that have continued that negative sentiment. The market, this session, the bullish sessions open slightly lower. So we've got a gap lower, a gap open lower. And then the buyers at some point in this hour have said enough is enough. Let's take this market higher. We've got a succession of things to sort of tick off here. We have gone above the previous closing price. We have then gone above the previous open price and we have closed above that. And as I mentioned earlier, we have completely taken out the high of the previous session. So the bulls have entered the market and had a great session and they've managed to close above the previous session's high. So this would indicate a strong reversal pattern and it's definitely the sort of pattern you should keep an eye on. In terms of trading, what you'd look to do, you'd look for a break of the high of the bullish signal. Should that break, then you would look to enter a long position. If you were looking to manage risk, you would probably look to put a stop around or just below the low. I mean, this low here ties in with previous session lows. You've maybe, in this example, be wary of this. So it could be that there's a low outside of this range. But again, these are all kind of additional points that you should be considering yourself when entering a trade. So we're looking merely for the signal here that the sentiment may be changing. If I zoom back out, you can see that, excuse me, you can see that the trend changes and it continues to go higher and higher through November through to December. So a few weeks there of rally. So it really is a strong signal. So that's a bullish engulfing. We're looking for a downtrending market. We're looking for a negative session to be entirely engulfed by a positive session. And then obviously we're looking for subsequent price action above the range of that bullish signal. So that's a bullish engulfing. Now let's take a look at a bearish engulfing. So as I say, the bearish engulfing pattern is the opposite of bullish. So we're looking for an uptrending market. I have this here. So this is a daily gold chart. We have this uptrending market here. And we're looking for a positive day or a positive session. It's a day in this case, but we'll have a positive session to be completely engulfed by a negative session. So we've got the uptrending market, and if I zoom in, we have, let's look at the top of this. So here on these two, so what we have here, we have a positive candlestick here that's continuing the trend that's occurred over the previous weeks. And then we have a gap open higher. So we've opened higher than the close of the previous session, in this case a day. And the close completely engulfs the previous body. So this negative or bearish, this bearish period, in this case a day, this bearish day engulfs the previous positive body. So let's just go through the steps again. So we've got a gap higher, so we've opened higher than the previous close. We've then, the sellers have entered the market, forced the market below and back through that previous closing session. They've also then traded through the body of that previous positive period and closed the market on that day below the opening level of the previous day. So we're looking here now to say, hang on a minute. So the sellers have come into the market. They've, what was a shaky start for them, so the opening level was above the previous day's closing level. They've entered the market and they've sold it, and they've actually won the battle on that day. So they've forced it lower and it's closed below the previous day's opening level. So that's saying the sellers have wrestled control of the market, and now we're looking for further confirmation of that. So a break of these levels here, we would be looking for a sell entry. So if I zoom out, you can see that the market does, I mean, that's quite a good indication there of a bearish engulfing. We get this move lower. It doesn't trade, if I zoom back in, it doesn't, interestingly, it doesn't trade back above the high of this bearish engulfing day. It doesn't trade back above that. So we shouldn't be in fear of being stopped out on any kind of sell. We should be looking for a stop above that level. So any sell that is entered around here, around the break of this low, we should be looking to run. So again, it's a real good example of a bearish engulfing, because the market does trade much lower over the previous, or so over the next 6 months or so. So it's a real good signal. And as I say, bullish and bearish engulfing patterns are very strong signals with further price action validation. So we're looking for then a subsequent action to break the levels that have formed those patterns. So I hope you enjoyed this video, and please do check out the rest of our videos in our collection.